up with a more general question. With the hindsight of the experience of the boom and bust you have seen, what general lessons do you draw on to deal with such rapid credit growth in order to avoid the slump and the massive deleveraging process?
Many. And I think it's a very wide-ranging topic, so let me offer some thoughts, wide-ranging ones at that. So why did the whole thing happen in the first place? I think that, you know, there were various things specific to Hungary. We had a disinflationary period going into the boom years, meaning that Hungarian nominal interest rates were high. So there was this massive interest differential between forint rates and let's say euro or Swiss franc rates. Now, why that was perpetuated for many years, it's again a very interesting question. We don't really have time to answer that. My own take is basically, you know, you pay the premium because of rare events, large rare disasters, which actually happened in the crisis, but it's really hard to predict them ex ante. And for that reason, these rare events are not really priced in. So this, more specifically, I'm talking about the large depreciation that actually happened in the crisis. So the failure of UIP or the apparent failure of UIP, the uncovered interest parity before the crisis. It's really, really hard to price in these rare disasters, rare events, rare big depreciations. And there's a lot of evidence, I mean, coming from sort of paraphrasing Reinhard at Rogoff, that people felt that the time was different. And you can sort of expect the exchange rate to be stable, this interest rate differential to be large, and just take advantage of these two. Okay, so and in the end, again, people tend to forget about, like, you know, past crisis if that happened 20 years ago. Okay, so that was sort of one part of the setup. Then I think that expectations about the future are crucial in the build-up of these imbalances. Basically, we just joined the European Union in 2004. Things looked bright. Income growth was still relatively high in Hungary. People expected it to stay high. And so these prospects are crucial for people to go into these long-term contracts. And I should also mention that these are expectations, right? We don't know what the future would bring. And expectations are heavily influenced by the available information. For example, you know, government communication about what is expected. So, I mean, all these dynamics of joining the European Union, having bright prospects, having this interest differential, stable exchange rate basically led to a seemingly very profitable strategy both on the bank side and on the household side. Now, on the regulatory side, our problem was that we did not really have a macroprudential agency. We did not really have macroprudential regulation. The central bank sort of had to form opinions about financial stability. The central bank was watching financial stability risks, but it did not have the regulatory power to do anything about that. We had a microprudential agency, which basically would not focus on systemic risks. Again, maybe partly because nobody was really aware of the extent of these risks. And we also, sort of from the government side, finance ministry that maybe could have legislated something. All this interfered with the electoral cycle. So again, as long as incentives on all sides were to maintain the system, it was really hard to come up with anything. Unless you have a strong regulatory agency that can take the long-run perspective. So now we have that. Now we have basically merged the macroprudential regulatory activities and monetary policy within the central bank. So now the central bank has access to all the tools that may be useful in this respect. And, you know, for practical purposes, obviously, sort of PTI regulations, payment to income ratios are useful, loan to value ratios are useful. I mean, in the end, eliminating foreign currency lending obviously is something that solves the problem for the future. It has a welfare cost, and I guess that's the main thing about all the regulatory questions. More regulation imposes welfare costs. Okay, it has welfare benefits if you have a big crisis, if the worst happens, but it has welfare costs. And to properly evaluate these costs, you basically have to have a really good understanding of the stance of the economy. You have to have a really good understanding of where we are in the business cycle, let alone in the financial cycle, which tends to be longer, have longer swings and much more difficult to identify. So the tools are there, and I think it's better to be prudent and cautious than to wait and see what happens. I think that's what the crisis has taught us, but still the world is uncertain, and I'm not sure in the end we could have probably decreased the scale of the problem significantly, but I don't think we could have eliminated it. So thank you.
Thank you for sharing with us the experience of Hungary. Now let me proceed with Romania. My question to Florian is related to the housing price bubbles. Romania stands out in the sense that between 2005 and 2007, housing prices doubled. And my question would be, what's the experience of your country with respect to curbing these kind of exuberance bubbles? Do you also, or do you have experience besides of the traditional macro-potential measures related to the banking system? Do you also have experience with tax policies, for instance?
Well, the measures that were taken by the central banks those days were not explicitly implemented to curb the high real estate prices, to curb the high growth, the real estate prices. In fact, the measures, even they might deliver such an outcome, aiming at ensure that both the lenders and debtors would be able to cope with a material decrease in prices. And this is quite a material nuance if you have to look the ways to have this perspective. Because if you have this perspective, then the measures we have implemented, you'll find them across the entire real estate cycle, not in the upward, in the swing, upward swing part. But when we look at the effectiveness, I think the efficiency was rather limited. And we embarked upon two avenues of measures. The first one would be the classical monetary policy, and the other one would be what right now we call it macroprudential measures, but at those times were administrative measures, and we were encouraged to get rid of them. Right now, we are encouraged to have it in place. About the macro, comparing the macro policy measures and the macroprudential measures, I think the macro policy measures were less effective, and the explanations might go into three directions. The first one is that we have, and we had those days, a high level of eurization, especially in the real estate market. If I remember well, more than 90% of the transactions were in euro. The second explanation is that the banking sector is not, and the loans, the real estate, the mortgage loans delivered by the banking sector are not the driver of the real estate transactions. If we compare the figures, the number of real estate loans and the number of real estate transactions, even in the boom period, it's 1 to 7, 1 to 8. That means the finance provided by the banking sector is not the main driver. So the transmission mechanism from the monetary policy to this area would not work very much. And the third explanation, I think we witness a material inflows, foreign capital inflows to real estate and construction firms. And your efficiency fighting with the interest rates or whatever is not very substantial when you have such large inflows going to the real estate market. So I think that looking back to what happened, the macroprudential measures like loan to value were the most effective. We implemented in 2003 a loan to value of, at that time, was 75. We had to get rid of these measures due to our EU accession. And at the beginning of the crisis, we re-implemented. But again, looking how the real estate prices developed, I think the main triggers were more about euphoria. It's not too much related with the fundamentals or economics stuff.
Thank you. Romania has also experienced rapid credit growth prior to the crisis. My follow-up question would be, how do you assess successfulness of the various measures with respect to general credit developments, irrespective from housing?
Well, here I think it was a big club. It was Poland, Hungary, we are us, and the list might go on. So the levels, the rapid growth of lending, especially the FX, showing figures like 30% increase per year was quite a normal stance those days. And this is only what we figure out from the monetary survey. But if you add up also other three elements, the loans delivered by the non-bank financial institutions, the loans that especially companies go directly abroad and pick them up, and also the loans that were externalized by our domestic banks especially to the parent companies. So if you add up all this stuff, you'll get bigger figures, especially in FX. And we took, I think in order to cope with this rapid growth, I think we've tried almost everything. And in quite an early stage, we tried monetary policy measures. Imagine that the reserve requirement ratio for FX was hiked to 40%. And if I remember well, the year when we had 40% the ratio of required reserves, the domestic lending activity grew by more than 50%. We had prudential measures. We had tougher provisions to cope with expected losses. We call additional capital for banks. We also brought under the central bank umbrella the non-bank financial institutions because we noticed some arbitrage in the lending over there. We had some bilateral agreements with some other central banks. Also, in terms of macroprudential measures, we implemented loan-to-values, also debt-to-income ratios, quite tough. All in all, I think that the efficiency of the measures was mixed, and rather limited. Mixed because, again, I think on top of the efficiency were the macroprudential and what we call prudential measures, microprudential. And again, the explanation for this behavior, I might spell out three explanations. The first one is that, again, when you have a large arbitrage opportunities, 80% of our banking sector is in euro area hands. So if we impose tougher measures here, they go abroad and deliver what they want. So the arbitrage, when you don't have measures that would be implemented, a playing field across the EU, might put your instruments in quite difficult. The second explanation is the high level of FX lending. And I told you that when you have the abundance of capital inflows, in addition with capital account liberalization, and in addition of euphoria from both lenders and debtors, the risk is underestimated. And if I have to conclude which were the most efficient measures, I flagged two of them. The first one would be debt-to-income ratio caps, and the second one would be loan-to-value caps. And we noticed that another instrument that was not implemented but ex post, we noticed that might work quite well, was loan-to-deposit ratio. It's what also you guys from the Bank of Austria recommended to some countries in order to not to behave so procycle and also to maybe deal with rapid growth. And I think that this instrument might be used in the future if new lending activities will go on. And I'll end up my response saying that I think there are a few lessons we've learned from this era of rapid growth. The first one is that without a good coordination across countries, the efficiency of a domestic measure would be quite low. And nowadays we have this European Systemic Risk Board, that one job is to ensure that across the EU you have a level playing field standards for the macroprudential instruments. The second lesson is that it's better to look of the indebtedness of the debtors and not to the lending activity. Because if you look only to the lending activity, you get rid of loans from the non-bank financial institutions, loans directly from abroad, or loans that externalized by the banking sector. And believe me, for our companies, they borrow more from abroad, directly from abroad or from the parent company, than from the domestic banking sector. And you would, the message from the monetary survey, if you look only to the lending activity delivered from the monetary survey, might be misleading. So this would be the second lesson. Look at the indebtedness and look at the debtor perspective, not the creditor perspective. The third lesson, but again, I might be biased, our financial stability, I work there. It seems that macroprudential instruments prove to deal better the lending lending activity growth than the monetary policy. But again, think about the situation that were in many European emerging countries. High level of FX lending and euroization, big capital inflows, and so on. And I think the last message is that it is useful to look at the link between the credit cycle and the business cycle, because even the lending cycle would behave sustainable, whatever that would be. This does not necessarily by default would deliver a sustainable economic growth. And also the idea that an unsustainable financial cycle by not necessarily affect the business cycle.
Thank you. I think you raised very important points, two eminent points, the role of loan-to-deposit ratios. I think when we look at those indicators, we see that they have come down, of course, partly due to the deleveraging process, but also due to the fact that local refinancing has increased, which was a very important endeavor. And the second one is what you said, you mentioned as arbitrage opportunities, and I think you also said with the increased international cooperation on the supervisory side, the setting up of a banking union, and hopefully also the opt-ins of some of the non-euro area countries. I think these arbitrage opportunities should vanish in the long term.